Okay, so welcome everyone. So today's webinar is on improving your cash flow and specifically around credit control for small businesses. As I mentioned before we got started here, as everyone was coming in, Gerald Barnes is actually the star of the show, and I'll introduce Gerald in a minute and explain how this whole idea came about. But firstly, just wanted to welcome everyone. I know everyone's quite busy, life's busy, business is busy, so I really appreciate you all attending today. And if you've got lunch, if you're having lunch while you're attending, then feel free to munch away. So just very quickly, introduction to myself. I think a lot of you already know me or may have seen other things from me in the past. And I'm a business coach. I'm an accountant by training. I've been running my own business coaching and advisory business for over 20 years, mainly focused on working with established growing businesses that want to better understand how they can put in place the foundations for growth. And as it says in that third bullet point, mainly focusing on areas like planning, productivity, team performance, and profit improvement in general. So that's all I wanted to say as a quick intro. I'm going to stop sharing and get Gerald to share his screen. And while he's doing that, I might just explain how this came about. So I met Gerald through the local Penrith Chamber of Commerce. We're both members. And actually, I'm not sure if you were a member then, Gerald, but anyway, I think you were there and we were connected by another common acquaintance. I caught up with Gerald for a coffee afterwards, which I tend to like to do after I meet someone that I resonate with at a chamber event or a networking event. And I could really tell that Gerald had a wealth of experience from the big end of town, but also working with a lot of smaller businesses. And I thought especially with the economy, a lot of people being affected by, sorry, just letting some people in, being affected by reduction in consumer spending and that flow through to business. Payday supers coming as well from the 1st of July. So there's all these cash flow concerns that businesses have at the moment. And I thought it'd be great to get Gerald on and just share what he knows about credit control, invoicing, cash flow management, and those areas. So this is it. So over to you, Gerald.
Yeah. Oh, thanks, Anil. Thanks for the introduction, and thank you everyone for attending. So, as the first slide says, this is all about improving your cash flow and with an emphasis for credit control for small business and SMEs. So,
And if anyone has any questions while we go, just pop that into your chat window and I'll monitor the chat and I'll also just jump in and let Gerald know if anyone has any questions. Plus, there'll be a Q&A opportunity at the end as well.
I've got an issue already, Anil.
Have
I
you?
can move the slide, yeah.
Just if you just click on the screen somewhere, it should just move forward.
Yeah,
Yeah.
that's better. Yeah.
Yeah.
Okay, thank you. Technology is a wonderful thing. So today's session, just basically by way of introduction, just want to stress a couple of points about why credit management, and call it credit management, credit control, debtor management, those sort of terms are interchangeable. But why it is important is because it maximizes cash flow and at the same time it minimizes your exposure to bad debts. So they're the two key reasons for having an effective credit control procedure policies. So that's the purpose. Then I'll move quickly into just a couple of comments about myself. Then we'll talk about a solid foundation and getting things right at the start. So it's all about giving yourself the best possible chance of collecting an invoice as quickly as possible. Then we'll talk about invoicing, a couple of tips on what you should be doing when you're not necessarily, you know, um, your invoicing system, but when you've raised an invoice, what you should do then to make sure that your client has got the invoice and you get it paid as quickly as possible. Then we'll talk some about some points about collection strategy. Then we'll talk about debt recovery itself if it all goes sour. I come from an insolvency background as well, so just talk briefly about that. Then we'll move into credit risk management and then the key takeaways from today's session and some Q&A at the end. So that's what you look like after 40 years in credit management and debt collection. So, uh,
You look pretty healthy, I think, there, Gerald.
yeah, not too bad. I've survived and survived a few hair-raising experiences that I probably won't go into today, in case it puts people off from asking to get paid. But it's all part of cutting your teeth in the sort of early days. So. I'm a credit management and collections specialist. I've been in the game for 40 years. I'm not a lawyer and I'm not an accountant, but all my working career I've been in either debt collection or insolvency. So that's my background. I work with business owners of all sizes, CFOs. I've done consulting work for leading advisory firms with insolvency practitioners and have worked closely with invoice financiers as well. During that time, I've had extensive experience across a whole range of industries, and that includes, I know today we've got some an engineering companies, manufacturing, so accounting, the legal profession. So I've had extensive experience in those fields. So yeah, that's me. So we may as well get into the nitty gritty. So I don't want to say every slide or topic I put up here is vital or the most important, but this is really key. Um, Fraud is increasing, and as such, you've really got to know who you're dealing with. So, it's credit control 101, really. Credit check new customers, know who you're dealing with, who the directors are. If you run basic credit checks with credit reporting agencies, you'll get a report back which lists directors. You'll get an extract from a company search, and perhaps most important, you'll get a default history, and that can flag some real concerns. And a lot of the major reporting agencies, they'll give you some sort of credit score as well. So you can, if you're a smaller business and you're a little bit reluctant about, incurring expenses when it comes to, credit checking or joining bureaus, there's a couple of really basic things you can do anyway, and that's basic Google searches. I'd I'd I think that's something everyone does and should do in these circumstances. But there's other things as well that you can do. There's a free ASIC page where you can do ABN lookups just to make sure the company or I should say purported company in some circumstances actually exists. and that they're currently registered. Often fraud there's can be committed where there's an ABN number used, but the actual company has been deregistered. So just do some basic Google searches on, directors, just to give yourself some sort of comfort that you're dealing with, bona fide people, basically.
And
Um,
Gerald, while you're going through that last point, I might just
yeah,
ask everyone if I'm curious if anyone's using a credit reporting agency as part of their normal process of reviewing or onboarding customers or considering dealing with new customers. If you can just pop into your chat box, just yeah, it'd be great to hear if anyone's doing that as part of that normal process. Sorry,
yeah,
Gerald, I
yeah,
keep
yeah.
jumping
No,
the
that's a good point. Um, I'll just put a comment on there. You really should be getting customers to fill out a credit application when they come on board with you. Make sure that they acknowledge and sign the terms and conditions of business. And really, the key to this is to get a personal guarantee from the director. I'm a realist, and it can be difficult sometimes to get directors to sign personal guarantees. But I think it's really important, especially if things, deteriorate in the way they're paying, and that you have to take some sort of legal recovery action. Your best chance of success is often against a director who's going to have assets or potentially may have assets compared to a $2 paid up company. So that's important. And also, again, a lot of businesses are a little bit uncomfortable about explaining terms and conditions to clients, but it's really important that upfront you're clear with them about your invoicing and payment terms. Um, my experience is it's to get this potentially uncomfortable conversation out of the way early rather than have it when things aren't tracking so well. So they're just some tips on what you should do just to make sure that you're putting in place some systems that will give you the best possible chance of getting paid later on.
And while you're going on there, Gerald, I've just
Yeah,
got some comments here about people who, it's a mix of people. Some do credit checks, some don't. Someone here said no, but not yet, but sounds like they're going to.
right. That's
And
good.
one uses Creditor Watch, so I'm sure
Yeah,
there's a few agencies out there.
yeah. There's several, but Creditor Watch are good. They're highly reputable, and they also have some add-on products to reporting. But yeah, no, that's good. So maybe we've had one win already when someone says they're considering or they're going to. So we'll mark that as a plus. But so then just moving into invoicing, um, most of my talk is really about giving yourself the best possible chance to be paid as quickly as possible. The first step in this is to invoice frequently, especially businesses that charge time or bill on project based sort of work. So, first step in the working capital management is don't let WIP build up. So, bill frequently. You want to get your invoices out as quickly as possible. And Anil and I were talking about this yesterday. It's you want to give the impression to your clients or customers that um, you're serious about invoicing and then following through to get paid. If you're letting WIP build up past 30 days, 45, 60 days, you're billing it in one go, the customer will sometimes take that as a signal that if you're slow in invoicing, you don't care about getting payment further down the track. So I really think that's important. And then really, if you're dealing with bigger sort of corporations and businesses, you should really try and understand your customers' accounts payable cycle. So, how often do they have account payable runs? Do they have a weekly one or is it solely monthly? So that leads into when do they need to receive your invoice by in order to get it into a pay run so you get paid. So really what I'm saying is that if you know your client has a cut-off of say the 27th of the month to be able to be paid as using this example as a June invoice, and you've got to get your invoices and out to the customer by that date so that you get into the following month's payment run. If you don't, you'll be treated in some cases as a July invoice. You'll get paid at the end of August in some cases. So that really is sort of a key cash flow implication as well. And you really want to be on top of that. So, and again, a lot, most of you probably know with larger clients these days or customers, it's all about lodging your invoices on their payment portals. So making sure that you've lodged it and within the time frame that they specify and basically in the manner of how they want you to lodge it. So what I'm talking about here is most major customers will want you to quote a purchase order number on the invoice that you're remitting and a signed purchase order as well, or a signed delivery docket. All those things or items have to be completed before you'll get paid. And if you don't do that, again, they won't process it. They may not even come back to you in some cases that they haven't processed it. So what I'm saying is basically make sure your invoicing fits in with your client's expectations and that you have attached all the relevant paperwork that's needed to get paid. Collection strategy. Um, I think if you only take one thing out of today's session, the real key to success is to contact debtors before the invoice is overdue. And that means confirming with the accounts payable section that they've received the invoice and you get a payment date as to when it will be paid. Um, you may think that's a little bit over the top, but my experience over the years, if you're really serious about cash flow and getting paid on time, is that you make sure that your invoices are received and they're in the system for payment and do that well before the invoices becomes overdue. There's no point doing this if you've got a 30-day account, for example. There's no point doing this when the invoice is already outstanding for 45 days. So you need to be on the front foot. Again, resolve disputes early and not when the invoice is already outside of terms. Uh, Follow up promptly if I could put PDP, that's debt collection for promise to pay. So follow up promptly if the promise to pay is broken, and then continue to follow up weekly until you receive payment. And this is common practice. Don't think this is over the top or unnecessary. These steps need to be followed to make sure that you get paid.
Can I just ask a question
Yeah,
for the audience again? That
yeah,
first
sure.
point, it seems uh, I'm just curious, do people here check if an invoice has been received, if everything's fine, prior to payment being due? I'm just curious because I know a lot of people who send invoices, then they chase them up after they're overdue, and then the the customer's payment, yeah, the accounts team hasn't got the invoice or something missing. They haven't actually informed the supplier. So, I think it's a good habit to get into.
Yeah. And can I just quickly add there, it's the biggest reason why you don't get paid on time. It's not it's not like it's it's not because the company is going to become insolvent or other reasons. It's simply because they may not have received the invoice. And a lot of people react to that comment by saying, well, we've got automatic systems that generate emails, it goes out. But the key is, has it gone to the right person? Have
Yeah.
they got it? Have they approved payment? So there's some manual steps that you can take
It's
to
interesting, Gerald.
ensure.
In the chat, someone said that for larger accounts they do.
Yeah, that's good.
Naomi actually said that she doesn't, but she has a company that does send emails confirming that they've got the invoice.
Yeah,
Uh, that
could,
invoice is coming up and whether or not they can pay it on time.
yeah,
So it is. It's
yeah.
a normal practice. So it's best practice, I suppose.
It's it's best practice. And I do quite a lot of consulting work with sort of bigger organizations who are looking to improve their cash flow. And that's the first thing I always raise with them because you'll get comments like, "Oh, we're dealing with a blue chip company. We're going to get paid." Yeah, you will, but it's when you get paid.
Yeah.
Would you rather be paid within 30 days or do you want to be waiting for 60 or 90, which can often have
And David
happen?
also made a comment here that it's not just that the accounts department may not have received your invoice. It may be that the project manager who
Correct.
approves it hasn't done what they need to do before passing it
Yeah.
on.
Yeah, yeah,
So it is. It's there's
yeah.
sometimes multiple
Oh,
points
absolutely.
that it could be
Yeah.
delayed. Yeah.
So I guess if we use an example with this project manager involved, I've done quite a bit of work over the years with major engineering firms, and that's the first step. If it's going to a project manager to be approved payment, then make that call sooner rather than later. Number one, they've got the invoice, it's gone to accounts payable, but also you you're going to be aware of any sort of dispute or problem early rather than later. So, yeah. Debt recovery. So, what do we do if it all goes sour? I just want to make one point earlier as well. In the previous slide, there may be some occasions where you may have to enter into a repayment program with your customer, which is okay. So long, my sort of key rules here are avoid monthly repayment programs. It's just too far drawn out. Because often what happens if you do that, you wait a month to get paid, and then the first installment it isn't made, and you only find that out after 30, if you're extending too far down the track, you're opening up some potential problems for yourselves. So with repayment programs, I think key things here is get a payment up front and then either enter into weekly repayment programs or worst case fortnightly. Don't enter into monthly repayment programs unless it's absolutely vital or you think you're going to get paid. But that would be my advice there. So with debt recovery itself, um, you're you're going to have to turn the tap off if you're supplying goods or services if you haven't been paid. So you have to start thinking about stopping credit. So when do you do that? Do you do it if you've got existing credit limits in place, or is it when an invoice reaches a certain age, or is it gut feel you're uncomfortable with the level of debt or the way the account is being conducted. So you've stopped credit. What do you do then? You should really, the first step should be to issue a formal demand letter from your business. If that doesn't work, then you're into the realms of outsourcing to a debt collection agency or to a debt collection solicitor. So the other point I've put in there is defaulting with a credit reporting agency. And this is a really powerful debt collection tool, actually, especially for debts that, let's say in the range of anything up to 10 grand or 5 grand, the sort of level of debts where you're umming and ahhing whether you should actually commence formal legal recoveries because of there might be some cost issues. But defaulting with a credit reporting agency is can be powerful because it really affects your customers' ability to obtain credit. And for small business and SME, that's sometimes a lot worse than having to, be served with a stat demand or a statement of claim. You can draw that out for a year if you wanted to, not the stat demand, but statement of claim through the various courts. But you default with a credit reporting agency, your debtor is applying for credit, they're under pressure, they've got a default. So they'll often reach out to you to say they're going to pay it, and you get payment that way. Just quickly with defaults, you have to give written notice that you are going to be defaulting. And if the debt subsequently is paid, it doesn't get lifted from the debtor's credit reporting file. It just notes it as being paid and it stays on the record for 5 years. So, but it does note that it's being paid.
So
So,
Gerald, when we was talking about this yesterday, I think this is a
yeah.
fantastic. It's not something that I had a lot of understanding about,
Mm,
and you were explaining it to me yesterday.
yeah,
You mentioned that it's best for the company to
correct.
go through that default process rather than
Yeah,
say outsourcing it to you to do.
yeah,
Um,
yeah,
and but for them to do that, they need to be a member of the credit reporting
correct,
agency. That's what you
correct.
mentioned, yeah.
Yeah. So you need to be a member of a credit reporting agency, and then you can launch the default. And in reality, it's better if the company does that rather than someone like myself or a debt collection agent because you don't know what the relationship is going to be over that fight.
Mhm.
Customer might stop using the debt collection agency that lodges the default. Their relationship, they might have changed provider, whatever. But if the company itself defaults, then there's going to be a responsible officer there for, you know, within that 5 year period. So that's the reason behind that.
All right, good. I'll let you go on, but in the meantime, I'll
Yeah,
just ask if anyone has used that strategy or whether they've got any questions about that. But
yeah,
yeah, I'll better let you keep going. I know we
yeah.
just want to keep the time.
Yeah, yeah, sure. So just very quickly, insolvency. So we're dealing, people are trading at the moment in uncertain times, and with insolvencies, they did increase in FY 25. So there was 15,000 first-time appointments in FY 25. And on that slide, you can see the sectors that are involved. I won't go through that in any great detail, predictions from, so just quickly, this information is sourced from ASIC, so it's not something I've made up, and it's freely available on their website. They expect insolvency appointments for this financial year to be dropping slightly, but from memory, these figures were provided. This was a slide from about the end of February, beginning of March, and I think sort of predated the troubles that the world faces now. So, but as you can see on this next slide, they were up 43% on FY24. And as I said earlier, the appointments for FY26 expected to be slightly lower. But the important couple of key points on credit risk management. Um, how can you best sort of monitor your debtors ledger and the risk exposure on it? Um, Again, being a member of a credit reporting agency allows you to lodge a portfolio of debts with the reporting agency. And once those debtors are lodged, they will monitor any activity on the debtor's account. So if there's a judgment against them or someone has defaulted them, whatever the adverse information may be, maybe a change in directors, you'll get an email straight to your inbox which will flag those changes. And that can be, really important to have that sort of timely information so you're not in the dark about something. Um, a weekly debtors review for all internal stakeholders. Over the years, I've found this just really essential. There should be a weekly meeting between whoever has the responsibility within the finance team for debtors, sales, operations. So, and depending on the size of the business, you need a CFO, CEO attending as well, or a business owner. So all the key stakeholders within a business are aware of what your debt exposure is and who the problem debtors may be. Uh, so it can be as simple as, you don't want to go to a review meeting where you've got a list of 400 customers. Really, you need to pick out the top 20 with highest debt exposures and just make sure that everyone involved in the business knows what's going on with those particular debtors. And one of the things I like to stress is that credit control and credit management is just not the sole responsibility of someone within the finance team, like an accounts receivable officer or the credit manager themselves. It's a real team effort between everyone across the business. The most successful collections or credit management performances I've seen is that when you have a joint effort between all the key stakeholders. So I think that's really important point. And I've just left uh, a comment at the end, consider trade credit insurance, which um, you can insure your debtor's book or certain debtors against the possibility of bad debts. I don't have any affiliations with credit reporting agencies or credit insurance providers, but they're really things that you should consider. And with the credit insurance, it's often not as expensive as what people think.
Yeah, and
But
that's a good point, I think,
yeah,
Gerald, because I know it is, yeah, any insurance is expensive these days, but I've had clients who've used trade credit insurance to give them confidence to actually enter into a contract.
yeah,
And then yeah, so it depends obviously on the size of
yeah,
transactions and invoicing and so on. But yeah, definitely a great not just peace of mind, but also allows you to take the little bit that just be confident to win work more easily. Yeah, all right,
yeah,
good stuff.
yeah.
Can I
There's
ask while Gerald moves on to the next slide if
yeah.
anyone is using trade credit insurance here? Yeah, just be interested in knowing that.
So key takeaways. Know who you're dealing with, which we covered off earlier, obviously. That's really key. Uh, just touched on credit control being a shared responsibility. And what you want to do is, no matter what the size of the business is, to create a cash culture. And that means getting the invoices out as quickly as possible and getting paid as quickly as possible, and people within the business working as a team to achieve that. Um, Third point there, and I think this is really important. Don't assume that debtors that traditionally pay to terms will continue to do so, especially in today's climate. So you need to be on to every debtor, whether they traditionally pay on time or as close to time or terms as possible. You need to keep monitoring your ledger. As I said earlier, contact debtors before the invoice is overdue. And then finally, if you hit a roadblock to collection, act immediately. Don't sit on things. So be proactive.
Um,
And
And
that's,
while you were going through those points, Gerald, I just I'm actually it reminded me of a client that I'm working with at the moment that has a big cash flow hole because they moved from working with they're in a construction business.
yeah,
They moved from
yeah,
working with the one customer that was paying regularly to now they're doing a contract with Ventia, and a few of you probably know Ventia. Um, and the portal process, the approval, like the PM needs to approve, and then the accounts team need to approve. Um, and from doing the work to getting paid, it's literally 2 months at best. And
yeah,
we did a cash flow forecast which showed there was going to be a big hole, and he's got $170,000 due at the end of July. Um, and what he's been able to do is negotiate them, even though he's missed like the normal payment timelines and deadlines means that that's when he would normally get paid. But
yeah.
he's been able to negotiate to actually get it brought forward, the
Forward,
payment,
yeah.
which I think is, well, is it rare? It just shows that it's possible,
It's
So
possible.
especially if he's going to be doing all this work and not being paid for over 2 months to see the first payment. It's just
Mm,
ridiculous.
yeah, yeah,
So don't be afraid to ask the question. And even these big companies are able to be flexible if they want to keep their suppliers happy as well.
yeah. That's a good point, Anil. And just very quickly, another thing I didn't really touch on was what are your terms of trade? Why do they have to be 30 days? I know a lot of industries will only pay 30 days from date of invoice, but not all industries. And one of the first things I look at is, can you bring those terms in? So I always invoice 7 days, like my terms are 7 days, and that gives me the best possible chance to be paid within 30,
Yeah.
which most businesses would accept. So, yeah, that's another thing to think about as well. So that's my presentation. I guess we'll take
Yeah, no,
any
that's great,
questions.
Gerald. Now, if anyone wants to, yeah, if those can stay for the Q&A, that's great. If you can't, if you want to catch up with Gerald, just scan that QR code, and I think it takes them to the contact page on your website.
Yeah, it does.
Yeah,
Yeah,
so that you can either contact him through there or just fill out the form on Gerald's
yeah.
contact page.
Or send me an email
Yeah.
or just call me. I'm happy to talk.
So yeah, so if anyone has any questions, feel free to unmute yourself and happy to just take those live. Um,
Yeah, can I ask a question?
sure,
Hi
go
there,
for it.
Neil. Um, One of our biggest problems is smaller clients. For some reason, I think a lot of people know anything under 5,000 or $10,000, they know that it's going to be hard for us to collect. So we send them to a debt collector. If it's around about 200, 100, or $500, the debt collector says it's not economical to chase these people. We can't get any response from them. Um, Apart from this, I'm really interested to know about this credit.
The
What did you
default
call
the
it? Credit.
default process. So
Default.
just for your information, Gerald, Eddie runs a commercial cleaning business.
Yeah, okay.
And
Yeah.
and so and Eddie, these would be commercial clients, the
No,
small debts
no.
or residential.
Um, Well, it's a mix. I mean, we even had a solicitor sign up for a signage removal for $300. So you would think a solicitor would pay his bill, but he probably thinks that he's so clever that he can get himself out of it. I don't know. He's been sent to the debt collector, but I know what the process. All
Mm,
these
mm.
smaller bills, anything under around $2,500, it gets to a point where the debt collector says this is commercially.
Uneconomical to
Yeah,
pursue. Yeah.
yeah.
So Gerald, is that that defaulting process an option for those sort of smaller debts?
I think I'd have to double check what the limit is, but I think it's about $150 that's got to be outstanding for more than 60 days
Okay.
on commercial credit. So it's certainly an option. Um, I'm happy to have a chat with you at some stage, Eddie, as well, because like with debt collection agencies, it just depends who you're using, and uh, as to whether how hard they'll push for payment. They'll say it's not cost effective to do so, but other agents or debt collection solicitors will take work on. For example, another option would be a debt collection solicitor that may potentially issue a formal letter of demand for less than $80. So there's other options out there. So,
Oh,
but
I'll be interested. Are
yeah,
you a debt collecting agency or
I have my yeah
advisor?
I do have a debt collection agency. Yeah, what I try to do though is to stop that from happening. But yeah, look, but what I pride myself on is basically horses for courses. So I'm more than happy to have a
Very
chat
interested.
next
So
week.
I will be sharing this presentation, the recording, and Gerald's details afterwards, Eddie,
Yeah,
to everyone. So
Thank
yeah,
you.
feel free to organise a catch up.
yeah. But can I just finish that? It's the sort of work I do. It's horses for courses. If I'm not the person that's best placed to do what you want, there's I've got a lot of contacts who will, so who are better placed. So it's custom solutions basically.
Good stuff.
A lot of we deal with a lot of builders, and a lot of them won't give director's guarantee. And I
Yeah,
had one builder just laugh in my face. He owed me about 4,500. He goes, "I've got deep pockets. I'll just do it for the fun of it." When I said I'll take him to small claims. And now what I've gathered over the years, over the last 20 odd years, is that unless they want to stay in business and want to go for loans and all that, small claims is pretty much useless.
Mm. Yeah, look, I don't have an opinion on small claims, but what I'd consider for someone like I'd join a credit reporting agency. So I think that's, as Anil said, that's a real option for yourself. And okay, it's normal that directors, it's hard to get directors guarantees, but a
Yeah.
lot of debtors are, there's a lot of hot air comes out as well. And at the end of the day, no one likes getting pursued for payment with a judgment
Yeah. All right.
against
We
them.
might we might take you guys can probably
Yeah,
uh,
yeah,
catch up.
that's fine.
Thank
Just
you.
curious if there's any other questions, just conscious of time as well. But feel
Sure.
free. Any other questions for Gerald while we have him? Maybe not. Feel free to unmute yourself or just pop something into the chat. Otherwise, oh, we have, oh no, Juan's video just popped on. Does that mean you want to ask a question, Juan? No. All right. Oh, so Naomi's asking a question. Is it legal to add a late fee like phone companies, etc. do? Um,
Uh,
that comes back to the T's and C's, I assume,
it
Gerald.
comes back to the T's and C's.
Yeah. Naomi, what sort of business are you in? Okay. Anyway, that's fine. But yeah, if anyone's got any questions about, so Naomi's in manufacturing. Yeah. So I think what you can do is the late fees plus also any collection fees can be added to the invoice amount. But once again, it needs to be in the T's and C's. And so it's really
Yeah,
important to get the terms and conditions right first.
yeah,
And sure, we know people aren't going to read them all, but you need to supply them and they need to sign off on them.
yeah. Just one quick point on that. I think in Queensland you can add the debt collection fees anyway, but I'd have
Oh,
to
okay.
check that the legislation might have changed on that.
Yeah. All right. Um, any other questions? Otherwise, we might wrap that up. But really appreciate everyone staying on, listening in, and once again, I love just thank you very much, Gerald. You're a wealth of
That's
experience, and
pleasure.
it's good to get you in front of businesses.
Yep. Thank you. Thanks,
All right,
everyone.
thanks everyone.